Welcome, everybody. We'll give everyone a few minutes to arrive and then welcome, everybody. Welcome to our webinar about understanding the Main Street Lending Program Funding Forward. Please post your questions in the Q&A only. The recording of this webinar and slides will be posted shortly on our community site at realtime.inc.com. And later in the day, we will also email a copy to all participants. Briefly about myself, I am the founder and CEO of MultiFunding. We've been working with business owners and entrepreneurs for over a decade to help them find the solutions to grow and expand their businesses. I write regularly for Inc. magazine. I've advised prior administrations as well as the Federal Reserve on the business credit markets. I have a book out called The Growth Dilemma. And for my entrepreneur organization friends out there, I'm a member of EO Philadelphia. My lawyers asked me to share some quick disclaimers. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain about how to implement this program. MultiFunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. We encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. This is the time for us to be thinking about what is next for our business. And this is the time to be preparing, or rebuilding our businesses will be a battle. Any battle requires a strategy. Do we plan to pivot 5%, 50%, or 90%? What will our team look like going forward that we go into this battle with? And what ammunition will we go to war with? In this case, ammunition is cash. And in any battle, you need cash for offensive and defensive purposes. How much cash will be required to get your business back on a stable footing? What is the best case and worst case scenario? And where will the cash come from? And what does your future look like? And what options and possibilities do you want to consider? This is the lens I'd like you to consider the Main Street Lending Program. As part of the CARES Act, has $600 billion allocated in it. It is in effect until September 30th, 2020, and it is comprised of 3 facilities: the new, the priority, and the expanded. Let's dig in. It is important for everyone to know that Main Street is not an entitlement program like PPP. Very few businesses are actually qualified to get a Main Street program, and it doesn't make sense for everybody. If your business was badly hit by COVID-19 and you want a Main Street loan, your best chances to get one are with your existing lender. And if you plan to use a Main Street loan to expand and grow, more banks will be open to you. The program is live. Most banks who are doing it are up and running this week and starting to look at files. The Federal Reserve has published a list of lenders. It is not 100% complete and accurate, who are taking applications from new customers. And the program expires September 30th. So if you want to participate, you need to hurry up because these will take several weeks to get done. Existing lenders, if you have a debt with an existing lender, they might consider adding additional debt to give your companies more runway and protect their current liabilities. If you will have little debt and your business is doing well, you can go to a new lender. New lenders will be looking for strong credits and new banking relationships. Eligible lenders are banks and savings associations and credit unions. There are approximately 400 institutions participating in this program. It's not nearly as widely available as the PPP is and was. To be eligible for the program, your business must be established prior to March 13th, 2020. You need to have If you have more than 15,000 employees or 2019 annual revenue of $5 billion, you're too big. And you have to be created or organized in the United States with the majority of your operations in the United States. Let's talk briefly about the US Eligibility Test. That means that you and your subsidiaries have to have greater than 50% of your assets, annual net income, or annual net operating revenues based in the United States. If you are a subsidiary of a foreign company, you are eligible, but you do need to attest that you will not send the money abroad to your parent. Eligible business types include partnerships, LLCs, corporations, associations, trusts, cooperatives, joint ventures with no more than 49% participation by foreign business entities or tribal business concerns. Sole proprietors are not eligible for the program. Nonprofits are eligible, but under a different program with different rules that we're not covering today. Ineligible borrowers include developers and landlords and other specific industries such as sex, gambling institutions, etc. If you are part of an affiliated group of companies, your companies as a whole can participate in only one of the three Main Street facilities, the new, the priority, or the expanded. And the affiliated group's loan amount cannot exceed the maximum loan amount for that facility. Now let's dig into the facilities. The first two are the new and the priority, and they share some commonalities. These loans are secured or unsecured. They have a 5-year maturity. Principal payment is deferred for 2 years and interest payments deferred for 1 year. You will pay 15% at the end of year 3, 15% at the end of year 4, and 70% at the end of year 5. They are priced at LIBOR plus 3%. So as of today's rates, you can count on paying 3.31% for the money. Prepayment is permitted without penalty, and origination fees are going to almost all cases likely be 2%. The new facility loans go from $250,000 to $35 million. How do you calculate how much you might be eligible for? What you do is you take your 2019 EBITDA, you multiply that times 4. So if you take row 3 as an example, a company with 2019 EBITDA of $500,000, the maximum loan they could get would be $2 million or 4 times that, but you have to subtract their existing debt. In this instance, the existing debt is $1.5 million, so their potential loan would be $500,000. If that same company had only $500,000 of existing debt in row 1, their potential new loan money would be $1.5 million. What's important here is the lender's rights. So if you have existing lenders, they can have any rights in regular course of business, but they have to agree that if you go bankrupt, they will share rights with your Main Street lender. These loans can be secured or unsecured, depending on what you're able to work out with your lender. And you are able to take on additional debt after you get the loan, as long as they do not interfere with the core rights of your Main Street lender. The priority facilities go bigger. These go between $250,000 and $50 million. And these are calculated at 6 times your 2019 EBITDA. So if you take row 3 again, that same company with $500,000 of EBITDA, they could get a priority loan facility of $3 million. That company had existing debt of $1.5 million, their potential priority money would be 1.5. And if they had in row 1 existing debt of $500,000, their potential priority facility would be $2.5 million. What's unique about these loans is that you can refinance debt from other lenders into a priority facility as long as it makes sense for cash flow. However, in these loans, the lenders' rights have to be senior or on par with all of your other lenders except for your mortgage lender. And these loans can be secured or unsecured depending upon what you work out with your borrower, with your lender. Expanded facility loans are much bigger. They start at a minimum of $10 million and they go as high as $300 million. To take an example, in row 3, a company with 2019 EBITDA of $10 million. I'm sorry, let's go to row 2. $10 million of 2019 EBITDA, the maximum expanded facility they could get would be $60 million. If that company had $50 million worth of existing debt, their potential expanded money loan would be $10 million. The rights on these loans tag along with the rights of the existing lender, and they share all the other attributes of the new and the priority, except the fees to get in are a little smaller. For all of these loans, you cannot, except for if you're refinancing debt into the priority facility, you cannot use the proceeds to pay off any other debt early. You certify that you will not seek to reduce or cancel your lines of credit. And you certify that you have a reasonable basis to believe that you will not go bankrupt in the next 90 days. While you have the loan, you can repay a line of credit, including a credit card. You can take on additional debt obligations as long as they do not interfere with the core rights of the new lenders, and you can refinance maturing debt. There are certain compensation restrictions and requirements, and there are exemptions for these for tax pass-through entities such as S Corps or LLCs. While you have the loan and for up to 12 months after you have the loan, you agree not to pay dividends or make other capital distributions with respect to the common stock of your business. For those who earn between $425,000 and $3 million in 2019, you agree not to make more than that amount for while you have the loan and 1 year thereafter. For those who earn more than $3 million, say you earn $6 million, you take the difference between 3 and 6, 1.5, you add it to the 3, and your maximum opportunity is $4.5 million. You agree while you have the loan to make reasonable efforts to retain your employees. However, unlike PPP, this is not the primary requirement of the program. The lender will calculate your EBITDA the same way they have historically calculated the EBITDA if they've worked with you or any adjustments that you offer. And if they've not worked with you before, they will have to calculate your EBITDA in a way they have done it for similar companies like yours before. Your debt will include all of your debt outstanding and undrawn as of the date of your application. If you have an asset-based line secured by accounts receivable and inventory, the debt will be based on the amount you have borrowed, not the amount that you could borrow. So how do you choose between the new, the priority, and the expanded? Let's take en route to a company with $4 million of EBITDA and $10 million worth of existing debt. They could get a new loan of 6, a priority, or an expanded loan of 14. It would depend on what they could work out with their lenders, how much money they needed. Financing strategy is like offense and defense, and you have to think about both when you consider your balance sheets or your loans. I want to share with you 3 case studies about how borrowers are thinking about using the Main Street facilities. One is a company with a $3 million line of credit and $1 million drawn. They are planning on getting an MSLP for extra liquidity. They would rather not draw down their entire line and keep some liquidity. The other is a professional services firm whose partners will reduce draws by at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit over 4 years instead of 1. And the third is a company that has already been approached by several competitors who plan to close shop. They plan to acquire companies at pennies on the dollar and use the MSLP money to help. How much cash will be required to get your business back on a stable footing? What is the best case and worst case scenario? Where will the cash come from, and how will you obtain it? And as you look at opportunities, are you sure you're prepared to take advantage of them? Those are the end of my remarks, and now I'm going to ask Hannah to open up the floor for questions.
Thank you, Ami. While the new facility prohibits borrowers from seeking to pay off business line of credits, it's allowed for the lender to require the borrower to pay off and close the biz LOCs prior to closing a condition of getting a loan? And if so, would the biz line of credit be reduced from the maximum loan amount? In other words, would the loan amount be larger?
So let's say you're eligible for a priority facility of $6 million. And you have $1 million line of credit with a different lender that's not going to give you the loan, then that $1 million would go into your priority facility and get paid off to the other lender, and then you would get new money of 5. I hope that answers the question.
Is it possible to get a new facility loan if the borrower has an EIDL and wants to keep that EIDL? If so, is the only way to do that with an unsecured new facility loan, since collateral is not involved and thus no negotiation needed with the SBA.
It's a tricky question with the SBA, and we're hearing different answers about how an EIDL compares to will work with a Main Street. It's safe to assume that you will likely need to refinance it, and in that case, you will likely need the priority facility, not the new facility, and you can likely will have to refinance the EIDL into the Main Street loan. That could change, but that's our understanding right now.
Have you had any luck with the SBA in terms of either sharing the collateral taken for the EIDL? And if not, have they been cooperative in terms of allowing borrowers to refi for their EIDL into the priority?
We're having mixed luck on the first. It's quite difficult. I'm not sure who to talk to at the SBA about it, and doesn't seem like there are clear answers or clear priorities right now. But the SBA, if you choose to refinance the loan into a Main Street, they have no say in that. You just pay it off and that's the end of it. Folks, happy to take any other questions that you might have. Not a problem. Questions are going once. Questions are going twice. Questions are going thrice. Thank you so much for taking your time to be with us today. We'll be back online next Tuesday. And we will be sharing a copy of this recording with you. You should get it in your email. If you have any specific requests, you can also feel free to email out to us. Thank you so much for your time, and we look forward to speaking to you soon. Bye-bye for now.
Thank you.